I see a couple of folks are here. Can you guys just tell me if my sound's okay and if you see the first slide with the dog on it up on your screen? You can type your answer in the little chat. There we go. I see Dimitri said yes. Welcome back, Steve. Is the sound better than it was yesterday? It should be because I bought this fancy headset thing. Thank you, David. More clear. Good. Yeah, there should be less background noise because this has, it's one of these boiler room noise canceling Sennheiser jobs. Okay, let's give it a few more minutes and see if some more people roll in, and we'll get started in just a few moments. Let's see what we can do with this. Whoops. Okay, I need one more thing. Give me one more second here, guys. I'm gonna pause this here. One more thing will be useful. I have to do an extra step, and I've only done this 3 times with this group, and I have to do an extra step, which takes me minutes, so I apologize for that. It switches Windows out of arrow mode when you turn on a Zoom webinar or meeting. And so all of my cool shortcuts to jump from one place to another suddenly stop working. So it makes me more inefficient. Okay. One more sound check and one more video check. Sound still good, yes or no? And you should see the first slide. Cool. All right, let's get started. Welcome, everybody. This is going to be a kind of a repeat session of yesterday, but I'm doing it live, so obviously it won't be exactly the same, and there will probably be some new material along the way. And I may forget something that I said yesterday. So, but that's sort of intentional, different time frames. This time of the day on Sunday with, the market reopening while we're going to be talking, or right at the end of this session, that's kind of fun too. Please, if you haven't done it already while I'm doing this introductory and disclaimer stuff, take a look at the charts on the Facebook group, the context group of charts that I put up. That is a little bit of the discussion, and then toward the end it will be relevant. Alrighty. Now, contact information, again, if anyone wants it. Last time I did one of these, somebody said, I can never get your contact info. So it's going to be up here, and it will be up at the end again. Request regarding contacting me. Use email for things that require a conversation, where it could go back and forth for a while and it might not be timely. That way I can devote some attention to it. Use Twitter messaging or instant messaging on Facebook if you just have a really quick, or in the Slack group, you could do it there too. Just really quick, yes or no kind of questions. If I can answer them, I will. Anything you think's relevant to more than me, please post in the appropriate place, either in Slack or in the surfing group. Let's see. The standard disclaimer for this kind of stuff, we're here for educational purposes. Yeah, a lot of what you will see here is live and real money, but from a legal point of view, this is all education and none of it should be construed as reality. I see Dr. Shah has joined us. Hello. Everybody's muted. I can turn on microphones, although I'm not going to do it in this session. But if you have questions along the way or comments, just so you understand what I'm seeing, I'm doing the slideshow on my middle screen, and I'm watching the chat in a right-hand screen on my right side monitor. So if you have any question that's pertinent to something I'm saying as I'm saying it, please type it, and if I can kind of work it in, I will. If it's appropriate to stop and answer it, I'll do that too. Otherwise, we'll have a lot of Q&A at the end if it's just general stuff. Please don't ask anything there that's general until the end, because it will just serve to distract me from staying focused on this material. Okay, the agenda for today. As I said, if you're just joining us, bit of a repeat, but not really, because I'll probably explain things differently each time I do. This is why we're here. What is order flow? I'm going to give you a real simple definition, and we'll talk about that. And I'll tell you what it is. It's price and volume. Don't get caught up in indicators about order flow. You'll miss the point of most of our conversation if you do that. Why do we care about it? Because order flow is what moves the markets. And I will elaborate on that today and pretty much every time we talk. So how are we going to learn it in the next 8 or 10 weeks in these sessions? We're going to do it a couple of ways. I'm going to post material that you read or other people's workshop videos or slide decks if I think they're useful. And if I found them useful in the past, I'm going to show you the way that I learned order flow, which was using the linear regression channels. And that's why those are on the fast tick charts. And that's why there's been a little bit of conversation about them. I found that they helped me learn to understand the ranges within the range. And once I was doing that on those fast tick charts, transitioning to seeing it only on the domes was kind of automatic. And I realized that in hindsight, trying to teach someone last year. So that's why I brought it back in here. But don't misunderstand. I'm trying to encourage you guys not to use charts. So the charts are here because they're a necessary evil, particularly if you've come from technical analysis or any long training in, in that type of approach to the markets, technical approach. But it's really important to understand that things are different than whenever you got that material or whenever that material was actually created. So I'll elaborate on what I mean throughout this presentation today. Seeing order flow takes seed time. If you cannot commit to that, go somewhere else, find another business, become a chiropractor. This is something that is a learned skill. And I have to say that over and over again. And part of it I'm saying to myself, I've been doing this day in and day out for 6 years with order flow and for 46 years trading. And I still make some of the same mistakes when it comes to order flow that I'm going to try to get you guys not to make. Like using a chart view in my head or thinking about previous levels of support, quote unquote, or resistance. And I really want to encourage you to not use terms like that because they're just really not appropriate anymore. What is appropriate now are inflection points or areas of interest. And then when we get to those places, you got to see what people are doing. How are they buying and selling? And guess what? That's order flow. Regardless of your ability to learn order flow, and this is a really important point, a lot of conversation going on in Slack about this, you still need to figure out what your niche is. There's some people doing combines that are in the group, and I know a lot of people in that boat right now. Unless you have a real tight button-down edge, you shouldn't be in the combine yet unless you're just learning to manage risk, in which case it's a really good educational tool. But your Bubba is kind of the at least one setup that you can do day in and day out, that you know the edge and that you have mastered or at least started mastering execution. So that's the framework of this. Order flow is a piece of the puzzle. It's not the magic secret. There isn't one. Okay, an introduction to setups and what I mean when I talk about setups. We're going to do a lot of that along the way today. And then last, I'm going to talk a little bit about the structure of the workshop and just do's and don'ts and how to maximize both of our time. Because if you maximize my time, you'll get the most out of this. If you're wasting my time, then everybody loses. So I want to get everyone on the same page with that. Okay, financial markets are auctions. Is there anybody here today that does not understand that? And this is just, you got to really get this in your head. If you don't get what that means, just think about, any auction you've ever seen on TV, whether it's for cattle or artwork or whatever. People bid and the price settles at value and then someone else bids again and the price goes up. The only difference in markets is that prices go down too. You know, once we reach value, it doesn't end. We just sit there for a little while. And that is why you will hear me say, and other people say, that looking at charts that go left to right can be deceiving, because markets don't go left to right. That's an abstraction of time. You're taking the price behavior and you're stretching it out over time. So if you try to get your mind more trained to look at markets as going up and down, then order flow and the whole auction process and your general understanding of how to make money here will be clearer, I believe, and all the evidence with other students points to that being true. Why something happens, guys, is completely irrelevant. Get yourself out of the habit of rushing to look at the news when there's a big movement in price, or thinking that, you know, you can look at the economic news and game it ahead and say, well, if this happens, you know, I'm going to put an order in here and maybe I'll get filled. You're fooling yourself. The information flow is far too fast, far too sophisticated, and there's just too many things now that make that not work. Now, 10 years ago, 20 years ago, yeah, some of that stuff could be done. But right now, you just need to focus on the price action and the volume and not have an opinion. Don't say to yourself, you know, well, we're at 30.25, which means, you know, we should at least make it to 30.30. Again, don't project an opinion like that, and don't let an indicator tell you an opinion like that. Let the market's data flowing back to you give you that opinion. And that's the essence of the art and the skill of trading order flow. You're not using a statistic like the VWAP or Bollinger Band or anything like that. All you're doing is taking the data as it's coming in, and you're assimilating that into your opinion, which is solely based on that data. And then you're looking at your playbook of setups and you're saying, okay, these are the ones I can execute against those conditions right now. That's the process. So the only thing there that matters is the price and the volume. Nothing else. Pivot points don't matter, fibs don't matter, moving averages don't matter, none of that matters. Now, does that mean you shouldn't use any of that stuff? No, you can use that stuff, but understand those are just statistics. I hear this a lot. This is one of the examples of what you should not do. I hear this, well, you know, we're down on the lower Bollinger Band, or we're down on the 200 EMA, and we should bounce off of it. Total nonsense. It is not a physical thing. It's just a mathematical statistic about what happened in the past. But so many people have programmed themselves to think that way that the algorithms and the HFTs and the professional discretionary traders will eat you for lunch thinking like that. So you're going to hear me say this over and over again, but if that's the way you think, just erase your brain, tabula rasa, and start over, and we'll go from there. Yes, let the market data flow through you. I can't take credit for that one, but it's a great quote. That's from a buddy of mine in Hong Kong. Is there more to this in theory? Yeah, I would Google auction market theory or AMT, Steve. There's a whole bunch of stuff on the web about it. And most of it's, you know, just pretty much good theory. And yeah, it's good to understand that. It's part of what we're doing. I don't spend that much time on it because from my point of view, as long as you understand what I just said, that imagine, you know, we're not trading a futures contract, but we're trading art. It's a Van Gogh, you know, do I hear $100,000? I have $100,000. Okay, value's established. We have the point of control now. Okay, now someone says, I'll bet $101,000. The price ticks up. Now we have order flow to the upside. It's that simple, guys. It's really that simple. Don't overcomplicate it. Okay, previous price levels are easy to game. So they are, you're going to hear me use one of two terms, misleading or useless or nonsense, okay? What I mean by that is if you think of them as having a significance other than just an area that you might want to pay attention in, then they're nonsense. But if you look at it as like, okay, well, we're in the middle of nowhere here, so I'm going to go have lunch and have a cup of coffee and come back. And if we get down to one of these areas that are interesting, one of these inflection points, whether it's a fib or it's a pivot or it's a whatever, I want to really watch the order flow carefully there, because that will give me a clue as to what's going to happen there. And that area has involved a lot of traders before. Therefore, it's likely that they are going to participate there again. It doesn't mean they will. It doesn't mean there's support there. It doesn't mean there's resistance there. It just means that area in the past had a lot of activity. It's likely to do so again for that reason. Pausing there to make sure everyone understands that and it's crystal clear. Please ask if you don't get what I'm saying. So therefore, the term support and resistance, I don't want to hear those, okay? Because they really don't tell you what you want to know. They tell you an archaic, 10-year-old way, archaic in trading is 10 years old, I know, way to think about markets. And it's just not accurate anymore in this day and age. Okay, I don't see any questions. Key levels are areas of inflection, areas of interest, absolutely. Okay, so within the setup world, which is really what we're talking about today, it's really important to understand there's no magic. You know, it's just like indicators. It's just like what platform you're using. There's no magic here. It's just build something that will execute at least one setup consistently and then do that over and over again. That's really how easy this is, although it's really not easy. It's simple. But the execution, that's primarily emotional management. Feedback is your journaling and how you take your journaling and go back to work your playbook with it. But the piece we're focused on here is that second piece, finding setups that give you an edge. And I have 8 of them, actually 9 now, but 8 that we'll focus primarily on in this workshop. And that is where my head's at. What's going on in the 4 markets I'm primarily trading with respect to my playbook? What am I seeing setup-wise that's tradable? And then I get into execution mode and I go do it. And so that's what we're talking about throughout the whole workshop, and today introducing this concept of setups. What makes a setup good versus a bad one? Consistent. A good setup should work way more than 80 or 90% of the time. That doesn't mean you have 80 or 90% winners trading it. That just means that the set of circumstances you're watching consistently does the same thing. Okay? I'll explain that more in a bit if that's not clear yet. The second thing is it needs to be frequent enough to be useful. There's some really cool seasonal plays you can do in futures, like with heating oil, or the crack spread between crude oil and gasoline and all these other things. And they occur 3-4 times a year, maybe. So those are not good setups in the sense that they're just not there enough to make a living unless you have a really giant account. So you want to look for things that happen frequently. And in my view, frequently enough is daily. You want to see things that happen daily and multiple times a day. Oh, this is a really good test. I'm going to pause for just a second. Enzo, the little Maltese, is barking in the background. This is supposed to be a good noise canceling mic. Can you guys hear him? Tiny bit, just barely once. Okay, but it's not distracting? Good, good. Okay, thank you guys. That's why I just spent the $50 on this microphone. He's in another room, but he hears me talking and he gets excited. So, all right. So back to the topic. Consistent occurs multiple times during the day. You'd like to say 50%. 50% what? 50% better. Okay, of my loudness. Good. All right, thank you. The setups that we're looking at in the workshop, most of them, and I answered this in the Slack right before we started, at least 5 of them occur 4 or 5 times a day. One of them occurs every day, the open 5. But the open 5 is not just an opening setup, and I know that's a confusion. It defines a range that becomes the setup. You can do it, you can trade it right at the open, but you can also trade it in the middle of the day and the end of the day. So it actually repeats throughout the day as well. The next component that makes a setup a good setup is that the risk and reward are clear. Now, let me make a really, really important point here. I personally do not look at trades from a point of view of RR, like I want 2.5 to 1 or better, I want 4 to 1 or better. I don't do that. Now, I'm not saying you shouldn't do that. That's a good thing to be able to do, but that is not what I'm talking about here. What I'm talking about here is, for example, let's say it is one of the ledge breakouts we had all last week, and we're sitting at the top of the ledge and we're going to go up, and we've been going up all day, and it's just a question of when. Okay, that's a good risk reward because my stop might not be a tick away, but it's really clear that if it stops going up, what that looks like. And my reward, well, in that kind of a setup, it's going to be whatever the market gives me, but it's substantial. It could go on for a while, it could break out and then retrace. But again, the point is that I can have this conversation with myself and say, is it clear where those two places are? Jump down to the 2 bullets down to where exits and potential targets are clear. What's the most important thing to be clear? Your exit. Where is the trade no longer working? So that's the point here of bullet number 3. Risk and reward are clear, and where is the trade not a good trade anymore based on this setup? Bullet point number 4, low win rate, high reward, or high win rate, low reward, or both. This is a really controversial topic. We talked about this yesterday. I'll review a little bit about what was said, and I'll elaborate a tiny bit. In real hardcore, big ticket prop shops, the bigger traders are typically low win rate, high reward. But they're also dealing with big bank accounts, and they're not dealing with, for example, top steps risk management. And, that's something to aspire to. In my opinion, it's much easier as a new trader to learn how to scalp, or at least do, intraday scalps. And those are high win rate, low reward. And the reason I suggest that is because it gets you out of the emotional trap of trying to sit in a loser. When you're scalping, you're in a loser, you get out. And it also is really good for confidence because you're constantly winning, even if you're bad at it. So we'll talk a lot more about this along the way, but whenever you hear anybody's webinar, including mine, don't get married to anything they say. Try to get nuggets of gold information. And this one, after hearing so many of those, it doesn't matter if you have a 40% win rate, as long as your wins are so much bigger than your losses. And I beat myself up with that for 20 years. And then one day I woke up and I said, pardon my French, fuck it. I just don't need to think that way. I'm profitable and it works. So, and then I said, well, wait a minute. So the challenge here to Jeff is to be good at both. Can I do that, that real high reward stuff and still scalp when I'm not doing that? So that's what you will see in everything that is what I strive to do. My mission as a trader is to be the absolute best scalper on the planet in any instrument I scalp with my tools, not compared to an HFT with a PhD in math, but, within the realm that I'm trading in. And at the same time and I do it in a completely different account, also in my future, same platform, but I just keep it in a separate account where I put on those, what I call lottery trades, where you buy the low of the day and you say, all right, screw it. I'll just hold it till the close and see what happens. And those can be enormous winners. So that's what I mean. Yes, a 1-tick winner is much better than a 10-point loser. And you know what else, David Bishop, I would add to that? I'd rather have 3 1-tick losers than a 10-point loser. Much more educational. And many of you are struggling now with consistency, and you're doing fine for a while. And I know 3 of you in this room right now have told me this. And then you have a big loser and you're screwed. Guess what? That's because of this. You're trying to trade price levels. Guess what? You're not smarter than the computer's trading price levels. Start learning to trade order flow, and when you get to those levels, you'll know it. So that's my suggestion to every one of you in a combine struggling, and every one of you that has made it to step 2 and then got bumped out, or made it to a funded account and then got bumped out. Learn to have a really good way to make bread and butter with low risk, and then put your lottery tickets on when it's really asymmetric. Do I think for beginners that having an RMI is a good way to lose more money? You talking about the risk or the reward? Well, here's how I think everybody should look at the risk and reward. I'll go back up to number 3, or bullet number 3 here, Steve. It's you take whatever the market gives you. Until you learn that, then you're going to get beat up by the market. You can't have predetermined targets that are anything other than just little notions in your head. But if you sit there and beat yourself up, I took profits too early and I got to learn to let my winners run. Here we go again, guys. Loud and clear. Nonsense. Nonsense. That let your winners run crap? Nonsense. That's maturity. You get that after 10 years of trading. The way you learn to make money is by lots of little winners. because you learn not to lose, and that's what this game is about. So over and over again, I hear these old fart traders spouting that, and they are not right. They are selling education because they want you to think that you're doing it wrong. That's my opinion of that. I know, Blair, that's your struggle. I hear it just in your chat, but your struggle is slightly different. Yours is similar to Dr. Shaw's and a couple of other people in this group. You truly don't have an edge yet. You know enough to know where edges might be, but you haven't put it into a process yet. And when you do that, that's when you'll get consistent. If you have your setup defined properly, Blair, the exits are automatic. You don't think about them. So are the entries. I'll be sitting here reading a book or watching a movie and the trade's going on. You know, people say, you sit there all day watching the market? Yeah, I do, but I'm not staring at it. I'm doing all kinds of other stuff. I leave, I come back, but I'll just glance out of the side of my eye and I'll say, oh, wow, there's a Momo setup, boom. And I throw it on because I know the context already. I know where it won't work. I know that I'll let it go until it gives me X amount or it just keeps going. But I'm not thinking about it. I'm not being emotional. I'm not saying, oh, you know, God, this isn't working. What should I do? You know, I don't go through that at all. It's totally emotionless. At least that's the objective. Sure, you know, I've got it going on deep down, but part of it also is learning how to meditate and manage that. And we'll get to that too. By the way, one common misconception when you have a big giant account, that goes away. No, not true. You will still feel exactly the same way. The numbers are bigger, you know, it's 100 contracts instead of one, stuff like that. But what you do is you just learn, you know, look at the webinar or the chat with traders that I posted yesterday. Get comfortable being uncomfortable. Remember that, everybody. Get comfortable being uncomfortable. Then this is easy. Okay, last comment about what makes a good setup. In my view, it's understanding that a setup has a mode. And I break them into two. I have setups that are wait setups, which means I don't expect them to work instantly. I don't bail instantly unless they go wrong really fast. But what I'm really doing is I'm looking at the scalp trade as I enter it, it works or it doesn't, and I'm gone. And a wait trade or a wait setup trade is one where I'm going to come in and I might nibble. I might buy one and let it sit for a while, maybe then buy another one when it starts working. That's the distinction of a mode. Yes, that's off topic. That's why I ignored it. Okay, the 8 setups we're going to do in the workshop are these. No, it is not in this order. This is just the order they are in my process, and I cut and pasted, and I apologize for the image is a little fuzzy. I didn't see it float up till yesterday, and I have to fix that. These are the ones we're going to do. I realize that a lot of people don't know what these abbreviations mean. I will put all this in the Slack, but real quickly, I will just go through them. HMOMO is high momentum. That occurs anytime, 24 hours a day. It's a very specific look, though, usually driven by news or a tweet or something. But there's a lot of different types of high Momo. Remember that many of these setups have sub-setups, and I might approach high Momo based on news differently than high Momo based on, based on just nothing happening, but the market suddenly getting volatile. And you see that sometimes when large players are getting in or out, or when or maybe there's something going on overseas that doesn't directly impact us, but it's impacting the Forex market. So it's rippling, through the equities and programs, that kind of thing. Okay, the second one is an edge. A type of edge is a ledge, which is a really high probability edge. But edges are really good setups because the edge that refers to the edge of the volume profile, and a volume profile can have more than one edge. It can have 5 edges. It has to do with the edges of the high volume and low volume nodes, and then ledges, which are the edges of a session that in ideal circumstances corresponds to the ledges of other sessions. And again, when we get there, you'll learn a lot more about that. We're not doing these today. We're just going over an introduction. Range is literally the range within the range. You can do that overnight. I do that with gold. You can do that anytime during the day. It's a little dangerous in NQ and some of the thinner markets. because you can just lose control of it really quickly. But basically, you know, what you're doing is you're looking for symmetrical range days, or at least parts of days. And, you know, when it gets to the edges, you fade it, you know, so because the odds are it's going to go back toward the middle. That's what, you know, the whole idea of a volume profile or the value area or any of these statistics we use is that by definition is about 70% of the trading. And, you know, you've got the POC, which is, you know, the biggest volume point. And don't get caught up in what those numbers are. It's the most volume. Get caught up in what that means. It means the most traders decided that that price was of interest to enter the market. Okay, that's what it means. So that's why your charts don't matter, and that's why indicators don't matter. It's the psychology of the point. So the point of control is about interest. And so if we get too far away from it and interest starts waning, then the odds are we're going to head back toward it where it was more interesting. Again, it's that simple, guys, if you let it be. Okay, the open five, God, we've talked about this a million times in the group. I will give you tons of examples. It's the first one we're going to do. It's a staple. If you just do that, you could make a living easily. If you do it well, it's a great setup. It takes some nerve to really play it, particularly the early parts of it, but it's a fun one. One of my favorites. High volume reversal, whenever that occurs, it occurs. It often occurs right after a high Momo because it's the other direction. You know, like Trump will tweet and we'll crash, and then everyone will say, all right, that was nonsense. And then we'll slowly start turning around off that high volume point and never see it again. So good setup to kind of scale your way into. And scale your way out of, because sometimes the high volume comes right back. So, number 6, springs and upthrust. Those are the two Wyckoff or Wyckofian setups that I use. Again, they fall into the category with open five, as you could just make a living, whether it's in stocks or futures, by trading springs. Springs are the most consistent pattern there is in the market. They occur every day, all day, in every equity. All you got to do is decide what time frame you're trading and look for them. You can scalp with springs. You can trade swing trading over courses of months with springs. You could do whatever you want with them if you understand them properly. Why am I only saying springs and not upthrust? And upthrust is just simply a spring that failed. And it's the reverse trade. Any more Wyckoff than that, I'm really not interested in talking about. I know a lot of you guys have really delved into the Wyckofian stuff. I have too, and I understand it, but my point will be it's just not relevant. That's your mission when you read a book, is to pull out the nuggets that you can make money with. There's a lot of cool Wyckofian theory, but I really don't care much about it. All I want to know is there a good setup that I can see really fast and I can capitalize on? And that's what a spring is. Number 7, first hour high and low, also known as the initial balance or the opening range. There are thousands of traders that use this. It's a great consistent methodology. It's a much slower methodology because you need the first hour before you even trade. Personally, I think it's dated. I think you can make much more money doing others, but since it still consistently makes money, particularly it tends to predict very big moves, like when the market just totally is about to break down, we'll typically lose the first hour low after testing it. That's a really good trade to know, but you might not do it every day. You might not do it every week, you know, one of those. The flip, my favorite, absolute favorite trade, but it doesn't occur that much. Across my 4 instruments, we'll get typically 1 a week, 2 a week. A flip is simply an overnight move on the typically overnight volume that the minute we open starts rolling over and never looks back. Now, sometimes it's slower than that, and I'll give you the rules and how to trade it when we get to it, but it's always the most lucrative trade because typically, you know, we'll get one of these 300-point Dow moves overnight, and then, you know, we open and it just starts filling that gap. And so, you know, if you think about it, you can scale into that and scale out of that and literally take no risk as the trade develops. And I'm not exaggerating. You literally have no risk. You don't have a tick because it's working into your favor. But if you don't trade it well and, you know, and you read it wrong, it can kill you. So anyway, obviously you're looking for asymmetry, which is, you know, high reward, low risk. And that occurs the most frequently when there's more than one of these at the same time. Like you'll get a high Momo into an HV reversal, or you'll get a spring that happens to be at the first hour high or off the open 5 high. And so those are the ones that typically pay off really, really well, but I don't look for them to necessarily all coincide. It just is a coincidence when they do. Okay. We'll pause on this slide for just a moment and I will take any questions. Not specific about any setup, please. I mean, if there's something I said that you don't understand, I'll be happy to elaborate just a bit, but I'm not going to go into every one of these now. So, but if you have a general question that you think everyone might have about any of the individual setups or the group, then please ask it here on the chat. Is my sound still working? Oh, there we go. Okay. When you say the value area, are you referring today's or yesterday's? I'm always referring to real time. Yesterday's value area, I know there's lots of guys that push that stuff. That worked 10 years ago. Sorry, Blair, I say this to you a lot, but a lot of the stuff that you bring up is older stuff, probably from when you read it. And this is going to be true of a lot of people, so I'm not picking on you. A lot of people call today's developing value. Yeah, those are the guys that still use yesterday's from 15 years ago. It's really important to understand why I'm answering you the way I am. The context of yesterday is different than the context of today. That wasn't that true 15 years ago, but with the information flow the way it is now, just because yesterday's low was the low doesn't mean that's an area that's going to interest traders. Yes, it will interest speculators, but they'll be looking to scalp it. So the programs you're referring to that look at those yesterday value areas and today's is developing and whatnot, those guys put way too much importance on what happened in the past and not enough on true order flow, which is what's happening right now. Is a high volume reversal similar to a spring? A high volume reversal typically is the way that a spring is initiated off of the low, but not always. Sometimes it can be in the middle of a trend, pull back and form a spring, because a spring doesn't require a drop, it just requires a consolidation. Did you understand that, Steve? Good. Okay. Any other questions in general? And if none of those answers made sense or the questions to the rest of you, don't worry. And if they did make sense to you, great. Don't worry. All of this will be repeated and elaborated on. But gosh, I really, forget the individual setups and what they mean for a moment. Listen to the undertone here. I keep going back to it. I beat up Blair and I beat up somebody else. And the point is, you guys have to understand that the vast majority of what you already know is useful only as context. Because if for no other reason, it's material that's probably 5, 8, 10, 15, 20 years old. And in this market, guess what? That's ancient. Those are really useful tools. But if you don't learn to read the tape as it's happening, those things will constantly mislead you. That's my point there. Whoops. Okay, workshop structure. I'm going to make things flexible. I'm going to try to be topical like I'm doing in this session, but please don't abuse that. A couple of people have already, and I've already spoken to them, whether it's in the Q&A in Slack or whatnot. Please understand, guys, there's 55 of you, and 50 are members, and there's a couple of guests here too. And if somebody's playing games with me about settings for Jigsaw Trader, for example, that they're really not even using it, but they want me to tell them my settings, I'm going to get angry and I'm going to give you one warning, and then I'm going to refund your money and say sayonara. So take that very seriously. I like to have fun, and I'm a real easy guy to approach, but if you waste my time, I will come down on you like a ton of bricks. Let me make that absolutely crystal clear if it isn't from that statement and from my tone of voice. Reading the tape, Blair, is what order flow is. Looking at the tick chart, looking at the time and sales going by, watching the dome, those are all reading the tape. So every session we have where we're looking at anything, I will refer to that term a lot of times interchangeably. You'll hear me say the order flow is positive, or the tape is positive, or there's a lot of aggression on the tape. I'm talking about the exact same thing every time. All of those things fall into quote unquote reading the tape. And yes, I will try in as many times as I can in the recordings and the live videos to actually show you the tapes going by. In fact, at the very end of this session, the market's going to open, and we might be able to do that a little bit. Okay, classes are posted. This is out of date already. There's already 6 or 8 posted. Everything will be posted in workshop. The workshop thread under calendar. All new ones will be there. All recordings will be under, guess what? Recordings. Please also just look at the, the way that I laid the channels out before you send me an email asking for the recording for the one we did yesterday. Everything, literally, guys, is posted there. And I went to a lot of time and energy to create that thing so that it would be easy for you to find stuff. If it isn't, tell me how to make it better and I will. I will add channels or whatever it takes. Please put the questions in the right channels though. That's important. I will help with that. We will do impromptu meetings and office hours. There will be assignments. The guidelines, it's always interactive around the core of whatever we're doing. And this last point I've been making throughout the day, but I really want you all to read it with me. Platforms, indicators, question mark. Yes, but our focus is price action, not the toolbox. A good trader can execute with any good set of tools. A good carpenter can build with any good carpentry tools. Yeah, it's nice to have your own, but get out of that mindset. So don't get stuck in, what's my setting for this or how to do this or that in Sierra. Do that in the background so you can follow along, but you'll learn a whole lot more if you look at the concept, even if you don't have your platform doing what mine is doing. If you want to follow exactly with what I'm doing, I'd suggest using Ninja and Jigsaw because it's just easy to do. Okay, these setups can be applied in the overnight session. Reading a question. That's a good question because I anticipated I didn't get it, and so I'm going to go back. The setups are time dependent. TOD, I referred to that. So if you look, for example, at my, hang on one second. I'm going to jump out of the presentation as I am wont to do when I want to show you the real thing. So bear with me for a half a second. Okay. This is my actual real process that I do this with, guys. And one of the parameters is right here in the middle of the screen where it says TOD instrument filters. Certain setups are for certain times of the day, yes. Am I going to elaborate on that any further now? No. So the point is, to answer your question, some of them can be applied in the overnight, some can't. As we talk about each one, we will examine whether that one's appropriate or not. I hope that answered your question. Okay, are there any other questions on this slide, workshop structure? I'm putting contact backed up because that is the end of the slideshow, which is perfect because it is 2:43 where I am, and that gives us a little time to watch the market open and just talk. So grab this if you want it. It's about to go away. Then we're going to do a real quick review. Okay. This is why we were here. I hope we accomplished this. No, you don't know what order flow is yet, but you know the definition that we're going to use for it. Number 2, you should all understand why we care. If you're trading without it, I think you're at an extraordinary disadvantage. Even just in trading some stocks, swing trading them, I think it's a disadvantage for executing your entries and your exits. What is overnight for me? Oh, I'm sorry, I never answered the second half of your question. Yes, I trade gold in my overnight, which is your daytime. If you look in the calendar, Helios, I hope I'm saying that right, you'll see there's a gold session at 7 p.m. next week. Okay, 7 p.m. my time, which should land right where you want it to on yours. Again, I'm going to have sessions. There'll be a midnight session for oil, my time, which will be, Europe, 8 a.m. So anyway, hopefully we accomplished this. You understand that this takes some time to learn and how we're going to try to do it. I'm going to try to help you guys find your Bubba. I may have to do that individually with you, but collectively a whole bunch of you need to take a deep breath, take a step back, stop trying to make money trading and learn how to trade. or stop trying to pass the combine and learn what it will take, the edge you need to pass the combine. I say that with love, guys. I see the struggle. I've been the struggle. When I'm struggling, I struggle too. I get it. But you know, if you're going around circles in the combines and you're not using it just to develop new setups like I do often, I'm doing one right now, and you're actually trying to get to their money, then you really have to be, you know, risk averse, and you really have to work that sequence of steps properly. You know, I'd recommend, for example, trading the 150K, and I would do it with 2 lots, 1 lots, you know, the scalping way that I show you. You can easily do $1,000 a day, and you only need 900 a day to pass the 150. So there you go. All right, we'll talk more about that at another time. I'm going to end the presentation, and I will take other questions. You'll see my platform here. Or no, actually, I want to ask you, is my platform up and running on your screen, my screen that is shared with you? Okay, let's see. I'm going to answer your question in a minute, Steve. First, can anyone tell me if this screen you're seeing is my domes? Okay. Hopefully the arrow getting turned off here by Zoom won't impact me too badly. The newer computer I'm ordering has so much horsepower it won't even ask for that. So I think we're okay. All right, let's see. Question. When seeing aggression, is it as simple as seeing the price move and time and sales speeding up? That's 2 of the 3. Anyone want to help them out with what the third is? Yeah, volume. Well, volume is part of time and sales speeding up. It rarely does that on 1 lots. So I'll throw that in with that one. So let's say one of them is price movement. The second one is volume or time and sales activities increasing. What's the third one? The dome is a tool that you see it on. We're looking for 3 criteria of aggression. Pulling and stacking, no. I don't care if they're pulling and stacking because those aren't trades, those are orders. They're lies. Ignore orders, ignore pulling, ignore stacking. Range of moves. Dr. Shaw is on the right track, but it's not the right answer. Okay, I'll give it to you. It is the price movement and the volume. Oh, you're close, Fernando. It's the delta. What side of the market are the big guys on? If we're moving up a tick and everybody's selling into that, then the odds are that move, it's got selling aggression, not buying aggression. But if we're moving up and everybody's buying and we're getting lifts on the ask and you're seeing big volume on the bid, and those big volumes on the bid are getting filled, not just being orders or not pulling and stacking, they are fills you are looking for, guys that watch order, stacking, and pulling. Once you see those 3 things, you know you're at least on the right side of the trade for the moment. Does that make sense? You want to see price movement, you want to see action, the time and sales speeding up, or volume, or both, and you want to see the delta that agrees with you. Worst case, you want a delta that's even. If the delta doesn't agree with you, you want to be concerned. Somebody's absorbing that move, at least for the moment. Think about it. If every uptick gets bought by 1 price point or 2 price points, and we tick up 1 and somebody puts 100 on, and we tick up down and it trades for 1, and we tick up again, somebody puts another 100 on. If you start seeing that kind of thing, somebody is selling very heavily into the price. Now, you say to yourself, what should happen? Well, the mistake is to predict what's going to happen. Don't. Say to yourself, okay, there's a lot of action right here, and at the very moment I'm seeing it, every time we tick up, somebody's selling. So 1 of 2 things can happen. 1 of 3 things can happen. 2 are likely. 1 is that guy stops selling and there are still buyers, so we continue to go up. That's one likely one. Another likely one is that guy keeps selling and he runs out of people to sell to, so we go down where he finds some more. Okay? Or it just dries up and consolidates and both big guys go away. And that's usually how the day ends. You'll see that battle until everyone gives up, and then we'll drift along. So, no, delta in options is completely different. Watch the video that was a prerequisite for this. I know you had a birthday, Dr. Shaw, happy birthday. Actually, it's not a prerequisite to this. It's listed in the Slack under videos from others. There's about what the delta is and how to use it from the guys at Axia. Please watch that and learn what we're talking about when we're talking about the delta. In order flow, the delta is the difference between trades going by at the bid and trades going by at the ask. And you must have a platform that measures that properly. Toss, for example, does not. It will show them backwards, as many old school platforms will do. Most order flow programs, platforms get it right. Jigsaw reverses the colors, which is something I really like. So I don't want to elaborate more on that, but that's you definitely need to get familiar with what we're talking about when we say the delta, the bar by bar delta, the cumulative delta. I will go into all that as we do different setups, but not in this introduction session. Other questions? You're welcome. Okay, well, if there aren't too many other questions, what I'm going to do is end this rather than having 10 minutes of dead space. And for anybody that would like to join me and just play at the open, I will do that as a separate instant workshop. I will post the link in the group, but I am going to, or separate meeting webinar session. So I'm going to end this one. Look for the link posted in announcements in the Slack in a couple of minutes. That will be a live session for the reopen. Okay, guys, thank you very much. If you have any other questions, hold them or put them in the Slack. I hope this was useful and educational. And once again, welcome to the workshop for those of you that are attending for the first time.